From New York City this morning, good morning, good morning. For our audience worldwide, a big day coming up. Equity futures positive 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York, we begin with the big issue, counting down to Chairman Powell.
Chair Powell.
Chair Powell.
Chairman Powell's press conference.
It's 2:30 when Chair Powell will lay out both the path and the trajectory.
The market's been teed up to be very hawkish.
200 basis points of rate hikes over the next 4 meetings.
How hawkish are they going to be?
It's a foregone conclusion the Fed goes 50 basis points.
What are the odds of 75?
The key priority for them is to get their policy rate up to neutral.
They'll leave all of the hawkish options on the table.
He's going to be very clear that he's going to be able, he will go as fast as he needs to.
They'll, ramp up the balance sheet reduction.
They've signposted it pretty clearly that they'll end up starting either in May or June.
They'll signal more hawkishness and more rate hikes ahead.
As far as where the surprise could be,
the potential for surprise really is in the press conference.
Let's get to the panel. Joining us now to discuss is Pimco's Erin, Browne, Bob Michele of JPMorgan with us too. Erin, first to you, your expectations for that news conference, that decision a little bit later.
I do think it's baked into the cake that the Fed will hike 50 basis points at this meeting. The real question comes to the guidance around future rate hikes. The market right now, as earlier noted, is pricing in 200 basis points over the next 4 meetings and then slowing to a 25 basis point clip thereafter. I think the question is going to be how forceful they are around that guidance, how clear they are around that guidance. Without a release of a summary of economic projections today, it's really going to come down to commentary around how they guide for the rest of the summer and then into the rest of the year. Our expectations is that they'll certainly move to above pre-pandemic levels by the end of the summer, but there could be bumps along the way, and there's a lot of uncertainty that still clouds the outlook. So the question really comes down to whether they continue to be allow some wiggle room around that guidance, or whether they really sort of take advantage of market pricing today and be very clear about what their likely outcome is to be. The other thing to look out is certainly how they guide towards the balance sheet.
Bob, just how high is the bar today, and how difficult will it be for Chairman Powell to out-hawk this market?
I think the bar is pretty high. I mean, I have 3 asks of the Fed. We think they're going to do 50 basis points. I actually want to know how many dissenters there are at 75 basis points and what he says about 75 basis points at the press conference. We think they're going to announce quantitative tightening starting with June and some sort of ramp up. I want to know, why not now? Why the ramp up? You're miles behind. Just start today at 95 billion caps. And then lastly, he's probably going to say everything's on the table. Well, great. What's the trigger for activating some of everything that's on the table? So I think he'll meet market expectations and leave a lot of unanswered questions.
Nomura shares that view on 75. They actually think we'll get 75, though. This is what Nomura have got to say. They look for 50 today, followed by rate hikes of 75 basis points at both June and July, before a more gradual pace of 25 basis point hikes, ultimately getting to 4% by mid-2023. Erin, many people think that question gets asked in the news conference later of Chairman Powell. 75 basis points, yes or no in the coming meetings. How do you expect him to answer that question? And what detail are you looking for?
I think he will leave the door open, but I don't think he's going to completely shut the door on 75 basis points. But remember, just a couple of months ago, it was pretty unheard of for the Fed to hike 50 basis points. They haven't done it since 2000. So it's been, 2 decades now since the Fed has made such a significant move with respect to, its policy, hikes. And so, well, certainly that remains open as an option. I don't think it's the base case right now of the Fed. And I think there's going to be a lot of ambiguity where the Fed will certainly caveat that it remains a tool in its toolkit. But I don't think right now with the Fed, sort of expectations, not pricing in 75 basis points a meeting, I don't think that the Fed is going to front run that with hawkishness today.
The decision, 2 p.m. Eastern Time, then the news conference, 2:30. And in between, apparently, we hear from the President of the United States as well. I'll catch up with AMH down in Washington a little bit later on that. Mike McKee, a busy couple of hours ahead of us.
Absolutely. And the question, as you've discussed it, is exactly right. How hawkish can the Fed be today? I think Bob Michele hit the nail on the head with the 75 basis point question, because if you take a look at the WIRP function on the Bloomberg and how many rate increases are priced in by the end of the year, you can see that right now we're at 32 basis points for an effective rate. And after today's move, we go to 85. But then by the end of the year, we're well over 3. And that has been moving up all morning. So to get that far by the end of the year, they're going to have to move more aggressively. And the way inflation is moving, they're going to have to do that to keep inflation in check. So today we're watching for the first 50 basis point move of the Fed since 2000. Or maybe do they surprise? The statement is going to have to change. They will probably say ongoing increases to the target rate will be appropriate as we try to set the market expectations for the future. And then it is all about how does Powell dodge that 75 basis point question? He's not going to promise anything, but he doesn't want to rule it out either, I would imagine. And then we get the balance sheet reduction details and the impact on rates. Now, the interesting question coming out of this meeting when they raise 50 basis points is if they do get to that 3% mark by the end of the year. What's that going to do to real rates? Well, it's only going to give you an effective Fed funds rate of about negative 2% because we're so deeply negative with inflation where it is now. You can see that's the change in the yield curve since the last Fed meeting, and the short end is still way negative in terms of its inflation rate adjusted the Treasury. So a long way for the Fed to go, and exactly where do they stop?
Mike, what do you make of the president scheduling a speech in between the decision and the news conference? What do you make of that?
It's hard to know. Obviously, he's looking for as whatever kind of good news he can. The problem for the president is that he's never on time, and Jay Powell is. So if the news conference starts at 2:30, the president's going to have to get there quickly enough.
The only thing I can promise, I'll remain committed to this. We will take Chairman Powell for you at 2:30 Eastern Time. Mike McKee, thank you, buddy. As always, a lift at the front end, yields up by 3 or 4 basis points, 282. That is the high of the year on a 2-year yield. Bob Michele, I was really looking forward to asking you this question. Have you got the clients lined up to say, let's put some money to work back into this bond market? What are they saying, and what are you telling them?
We do. For the first time in actually quite a bit of time in some channels, particularly the large plan sponsors, the pension funds and the insurance companies, they're looking at the backup in yields. They're looking at the backup in credit spreads. They can buy 30-year credit at 5%. There's an opportunity to de-risk. So those are the first conversations we're having of that type in a couple of years in earnest. We look at the retail market. I met with a lot of retail clients yesterday. They're sitting on a lot of cash. They did some de-risking. They're looking at the municipal bond market. At the end of last year, state GOs were about 1%. Now they're about 3% in yield. So there's a lot of opportunity there. And yeah, look, you have to appreciate there's been a tremendous repricing in yields and credit spreads and Fed expectations. And it's going to take a year, we think, for the Fed to meet those expectations, and the market will do well in that environment.
Well, just to separate a couple of things, help me understand this. Are they looking to play defense in the bond market a little bit more, or offense in the bond market a little bit more?
Well, they're looking to put capital to work for the first time in recent memory where they feel there's an alternative to equities, that they can actually buy the high yield market at above 7%. So they're at the top of the capital structure. They don't have to own the bottom of the capital structure to try to generate return. They're doing both. They're looking at, I said, de-risking because they've established these glide paths to meet their long-term liabilities. They've had a repricing. Why not take advantage of all the time you spent on that glide path and put some money to work? We're seeing both ends of the spectrum.
Erin Browne, does this resonate with you?
Very similar conversations that we're having as well. And, you keep in mind, I think a lot of it is a defensive move, just given the sort of level change that we've seen in yields. But I also think that this is part of the long-term, sort of capital market assumption glide path planning for, plan sponsors or for, even individuals, that they have been over allocated to equities because that was the only place that they could really pick up incremental return. And now there's an alternative to that. And so that they are starting to shift their allocations. The one comment we have heard has been that, some investors are waiting for bond volatility to subside. So if you look at the MOVE index on Bloomberg, that's one of the things that people are keeping an eye on, that once they start to see bond volatility subside, that will be the real trigger for them to start getting, more meaningfully involved in the fixed income market. But these yields are starting to look much more attractive, and we're having active discussions with our clients around it.
Erin, Browne, Bob Michael sticking with us going into the opening bell. We need to dig into this a little bit more. Before we get there, a ton of movers to talk about. Let's get to Taylor Riggs for more. Hey, Taylor.
Yeah, John here. Sorry, I almost called you Romaine. I'm so used to being on in the afternoons. John, take a look here at some of the earlier winners, of course, that we're looking at. CVS, of course, is one of those. Now, comp sales came in a little bit better than expected. And then, of course, we think about that forward guidance, actually raising that just a little bit, and something that we haven't really seen a lot, perhaps, in this quarterly earnings season. I want to point to Moderna as well. They're up 6%. Vaccine sales were better than expected, but similar comments that we heard from Pfizer yesterday, not increasing them a whole lot on a go-forward basis, given a lot of people are expecting COVID perhaps to move behind us when you think about some of the COVID treatments and the vaccines. John, we have to talk about Lyft. I think what was so interesting is yesterday after the bell, the numbers looked okay, and then you got on the conference call and you got a lot of that negative forward guidance. You got a lot of misses on the bottom line. You have a lot of commentary coming out about sort of the driver shortages and then the driver incentives. And those incentives, I think a lot of analysts thought were behind us. And that clearly is not the case, as a lot of those incentives are still very much going to be in the picture. And I think a lot of that, John, according to analysts, are why Uber was supposed to report after the bell today. They moved that up this morning. The numbers looked a little bit better, but it's sort of getting lost in the shuffle as people really think about the reopening and, of course, these big incentives that these companies are still having to look at.
Thank you, Lisa. I'm joking. I'm joking,
Sorry.
Taylor. I'm very happy to have you in the seat. You know that. Looking forward to your coverage through the opening bell. Taylor Riggs there with us for the next couple of days. Coming up, the EU planning to ban Russian crude.
So today we will propose to ban all Russian oil from Europe. This will be a complete import ban on all Russian oil, seaborne and pipeline, crude and refined.
That conversation up next.
We will make sure that we phase out Russian oil in an orderly fashion. So in a way that allows us and our partners to secure alternative supply routes and at the same time be very careful that we minimize the impact on the global market. And this is why we will phase out Russian supply of crude oil within 6 months and refined products by the end of the year.
The EU planning to ban Russian crude. The proposal, however, running into threats and objections from both at home and abroad. Hungary continuing to push back. Slovakia preparing to demand an exemption. The Kremlin responding, saying the EU will pay a bigger price each day. Joining us now from Germany, Maria Stadeo and Anne-Marie down in DC. Maria, walk us through the plan, please, piece by piece.
Well, look, let's take a look at the big numbers here. First of all, we now have official confirmation from the European Union that this new package will include oil. Remember, Jonathan, the choreography, and we've tracked this repeatedly on the show, was first we do coal, that's done, then we move to oil, that's exactly where we are right now, and then potentially into gas in the future. But it's not going to be easy. When you look at oil, what the European Commission is putting on the table is a transition period from now until the end of the year to do this slowly. That would give some countries, like the country I'm in, Germany, to adjust for it and prep their industries for this cutoff. It's also interesting that it's not just the oil, but it's the world around it. So this is the transportation of it, the insurance, the cargo ships, the vessels, all of this would also be banned alongside the commodities. But Jonathan, I should note and point this that a lot of this was already happening. When you look at the energy imports from Russian oil to a country like Germany, they had declined from 35% to now 12%. A lot of the private companies that deal with this did not want to touch Russian oil oil because they feared those sanctions. So in many ways, this is just catching up with reality. But as you say, this is already running into obstacles. The Hungarians are saying that they see this as very problematic, that this would have a big implication for their economy, and are prepared to veto it. So again, the question is whether or not the European Union will put forward an exemption that they find doable enough. At this point, there's a lot of tension between Viktor Orban, the Prime Minister of Hungary, and the rest of the European Union. And then you have the Russians saying, okay, go ahead, do it, but there will be retaliation. And by the way, it's a European consumer that is going to pay this on a daily basis. But I would also note, just a little cautious there, Jonathan, the Russians stand to lose billions if this goes ahead. And of course, we have seen that this invasion of Ukraine is now very long, it's very sticky, more than 70 days, and this costs a fortune for the Russians. And they have not been able to secure major victories yet. So for the Russians, it's also complicated.
MH, just quickly, we'll catch up with you again later in the hour, but the president's going to be speaking a little bit later. We've heard from him already in the last 24 hours. What are we expecting from him?
Well, the last 24 hours, what he spoke about really was about Ukraine. And he was at a Lockheed Martin factory where they made these Javelin missiles, which really have been incredibly not just useful, but really a turning point for the Ukrainians as they're trying to stem off the Russian assault. Today, it's all going to be about economics. He's going to talk about deficit reduction and then parlay that into the fact that what more can be done to make it a more productive economy, things like prescription drugs and all these items he talks about in his Build Back Better plan.
AMH, we'll catch up with you in about 20 minutes' time, and we'll see if we actually hear from the president between the decision from the Fed and the news conference from the Fed a little bit later. Thank you. Erin, Browne, Bob Michael, back with us. Bob, given what Anne-Marie just talked about there, fiscal discipline returning, you've talked about the bond buyers, they're back. You comfortable saying we might have seen the worst of it, the long end of this Treasury market?
I think for now. And I think what's important is for the first time in a long time, the market looks fairly priced to us. And you know, the surprise to me isn't that the 10 years at 3% today. The surprise was it was 1.5% at year end. And with the Fed fund forward curve out around 3%, 10, 12 months out, that's a long journey for the Fed to get there. Let's see what happens along the way. Let's get a couple 50 basis point rate hikes under our belt, some months of running down the balance sheet under our belt, and then see what the impact of those plus inflationary pressures are on the consumer and on the economy. Right now, we don't know, but it feels like 3% covers us for the time being.
Andrew Sheets of Morgan Stanley said something similar. He said this: what's already in the price matters. I can see a scenario where the Fed is being hawkish and is still hiking, but longer dated bond yields don't rise very much. Erin, can you speak to that, the relationship between what the Fed may or may not do in the coming weeks, months, quarters, years perhaps, with the longer end of the yield curve?
Yeah, I think that's right. I mean, I think that even in the front end, you've seen a lot of market pricing now priced into the front end of the curve, and that certainly trickles into the back end of the curve. And, you know, for us to have a meaningfully move higher in terms of yields from here, either the market expectations for the Fed have to move much more, hawkish, and that would affect the front end, or the market has to meaningfully increase its expectations for long run growth and inflation, which would hit the back end of the curve. And I think that given what's priced in the market today, I think that, and given, for the back end, our expectations for productivity growth and for, real growth in the longer dated part of the curve, I think that the market is fairly priced today. Now, could we see a little bit of continual sell-off of the back end? Certainly as the Fed continues to hike into, this environment, yes. But I think that the velocity of the move is certainly behind us. And I think that going forward from here, it's going to be much more balanced in terms of the volatility that we're seeing. And that's what I think is giving, some market participants comfort here, that there is value now in that back end of the curve. And we haven't seen this type of pricing in quite a long time.
Bob, just quickly, a man called Jamie a little bit earlier this morning said, deep breath and give the Fed a chance. Let's take a deep breath and give the Fed a chance. I'm trying to work out what these interest rate hikes will mean for this economy. When I get guest after guest on this show say things like household balance sheets are really strong, corporations are resilient, they're well funded, banks are in good shape. If that's the case, how sensitive will demand be to incremental increases in the interest rate from this Federal Reserve? Do they have to go more than perhaps some people expect?
That's a really good question, Jonathan, because I worry about the next 4 to 5 months for the Fed. I'm in the camp that they're going to do 4 50 basis point rate hikes over the next 4 meetings, because I think over the summer we're going to see the worst of the inflation data, and we're going to see this reopening burst in pent-up demand everywhere. You're already seeing it in travel and leisure if you've gone through an airport. And all of that's going to happen at once. At the September meeting, they're still going to be looking at very strong data. So I think you got to put 50 on the boards for September. We didn't get to the what question should Mike ask in his customary
well,
last
you could do it
position.
now, Bob. Take it.
What he should be asking is, what kind of conversation did they have about intermeeting rate hikes? Was that on the table? That's what I want to know. I think that is on the table.
I'll give you that, and you can have this too. I know you're a happy man today. You look happy. I know you're happy with last night. You're going to be happy this weekend. Will you be happy at the end of the season, Bob Michael, as a Liverpool fan?
Hey, the must-watch for me is 3 o'clock. I want to know who our opponent is. And while I'm tired of going head-to-head with City, do I really want to face a team that's actually better than them?
What do you think? Who would you rather play?
City. We
City,
know them.
every time. Bob Michael, thank you, sir. I'll be watching the Fed show a little bit later, because I'll be in the Fed show a little bit later, and I'll be missing kickoff of Liverpool Real Madrid. Bob Michael, Erin Browne. Bob, I hope you're on the training floor later and not watching
Real
that game.
Madrid.
Come on,
No,
City
City.
Real. Yes, yes, yes. City Real. I'll get my games right. Bob, forgive me. You should be my copy editor too. Coming up, the morning calls, and later, markets grappling with slowing growth and surging inflation. BlackRock's Kate Moore remaining cautiously optimistic on the outlook for stocks. 5 minutes away from the opening bell, equities up about 1/3 on the S&P. That's the price action. Here are your morning calls. Morgan Stanley downgrading Carvana to equal weight and cutting its price target by 70% to 105 a share, highlighting serious challenges to continue growing its business. Evercore upgrading Starbucks to outperform $95 price target, forecasting some stabilization in China trends by the fall. And finally, Susquehanna downgrading Lyft to neutral. $25 price target, expecting macro headwinds to continue weighing on shares in the near term. I think this is the second time this week we've talked about horses and barns and bolted and all that stuff. Down 27% on Lyft. I can confirm the president has moved that speech from 2 p.m. when the Fed was deciding to 11 a.m. Eastern time. That one makes maybe a little bit more sense. Your opening bout up next. "24 seconds away from the opening bout. Bob Michael still having a go at me for messing up my football games. I apologise, Bob. Futures are positive 0.2% on the S&P. On the Nasdaq, up around 0.4% on the Russell. On the Nasdaq, up a little more than 0.1%. That's the price action in the equity market. There's your opening bout. Switch at the board and get to the bond market. Yields look a little something like this. Up a basis point on a 10-year to 298. After having a little look at 3% earlier on this week. In the FX market, the euro showing just a bit of strength. 105. It's been tough to break. We've been holding on to it. Had a little look at 104 a couple of times over the last week, but didn't like life down there and have got back up to 105 okay. That's where we're hanging out on euro dollar. Crude 106.99, let's call it 107 now, up by 4.5% as the Europeans come up with a plan to ban Russian crude. That's the breakdown of things cross asset. Let's talk about Lyft and Uber and get over to the West Coast and catch up with Ed Ludlow. Morning, Ed.
Morning, John. Just a monster amount of earnings to get through. Going to start actually with advanced micro devices. AMD shares were pushing higher. Analysts really positive about demand for data centers when it comes to the chip sector, right? But there's a little concern about laptop PC demand. So you see analysts cutting price targets, even though the stock's up almost 7%. Of course, AMD, one of the worst performers on the Philadelphia Semiconductor Index this year. Airbnb, very similar story. Bullish outlook on demand this summer. Restrictions lifting in North America, helping travelers get out there, book vacations, and Airbnb reporting strong numbers. And then let's get to the story. Lyft now down 28%, John. Monster move, biggest in its publicly traded history, losing a big chunk of its market cap. Basically, a tepid forecast for EBITDA because they have to invest in driver incentives. Now, some analysts are saying this sell-off is overdone. You look at Uber also getting caught up in this general story around the long-term profitability of these businesses. But in the sense that it's overdone, they're saying, well, if Lyft is committing to spending on driver incentives, and even though they had softer than expected ridership in that quarter, it actually shows that Lyft has bullish outlook of their own, because they want to spend on driver incentives to meet demand that might not be visible right now. That chart, of course, showing both stocks since their IPOs pre-pandemic back in 2019. And it's not been a great story, John.
Ed, I know how hard these guys work driving these cars. You do too.
Right.
They work really, really hard to not make much money. Gas prices are up. They've got to pay for their car. Isn't this just the end of the era of cheap labour for these companies?
Yeah, look, I mean, Dara Khosrowshahi, the Uber CEO, kind of lingered on this point that actually driver availability was really up in the month of April. And what they're seeing is that they have a diversified business, right, where you can be an Uber driver, but you don't just drive people. You can do Uber Eats, you can do Uber Freight. And so in that sense, they're able to offer more to the drivers themselves. And that seems to have given them a competitive advantage over Lyft, which has the pure play riding.
Lyft is getting battered. It's down 29% in early trading. Ed, great to catch up. Thanks for waking up early on the West Coast to bring us some bad news about Lyft. And Uber, as Ed pointed out in the last 24 hours repeatedly, was due to report results after the bell, saw what happened with Lyft, brought them forward to before the bell. They had some good news to tell. They thought they did anyway, perhaps. We're down by a lot there on Uber as well. Elsewhere, investors gearing up for Chairman Powell, strategists growing increasingly concerned about the combination of slowing growth and high inflation.
We have slowing growth and inflation picking up, so some people think stagflation's a real risk. And we know that we have the removal of the central bank put. Returns are going to be a lot lower, and we're going to have to work really hard for our clients to find those opportunities.
That was Goldman's Katie Koch, and she's not alone. Taylor Rigg's back with us. Hey, Taylor.
Yeah, John, I think sort of the story that we've been talking about pretty much all year, and I know that you've been focusing a lot on it in the last few weeks of the program, is the defensiveness of this rally that's underway. And you see that with some of the staples. We're going to take out energy for all intents and purposes because that's a different story. Other than that, the staples have been the big sort of outperformers in this market, right? As you think about the defensiveness that has been the staples, the utilities, and really sort of the big outperformers relative to big tech and some of the classic more risk-on sectors. What's, I think, sort of been underlying this tone as you think about sort of the rising rates, sort of the sell-off in those long duration assets, and then, of course, the weighting on the S&P 500, the market cap index. Romaine would get so angry at me by looking at the equal weight index, but the equal weight index here has actually been sort of the underperformer. Typically, though, that hasn't been the case. Like this year, you're thinking a lot about sort of the equal weights and the big outperformance, given the sell-off in big tech and the big weighting that has had on that market-weighted index. So that sort of equal-weighted index is one that we've been watching on big days when you think about big tech getting hit the hardest. We've talked a lot about TINA and FOMO, John, and I'm not sure that maybe 3% on a 10-year is enough to get you excited. But if you think about a dividend yield versus a treasury bond yield and where there are some other alternatives out there, you could argue that perhaps maybe some of the yield advantage here on equities is declining a little bit, in part because you're getting a big sort of reflationary lift on bond yields. And what is that number when bond yields actually now start to compete with some of the equity alternatives out there?
Why does he not like the equal weight?
The same reason you don't like the Dow.
I know, but the Dow is so much worse. The Dow is so much worse than an equal-weighted S&P. At least it has the title on the equal-weighted S&P. It is what it is. It does exactly what it says it does.
Don't tell him. Don't tell him I mentioned it.
I'll message him later and find out what the big deal is. Taylor, thank you. BlackRock's Kate Moore joins us now. Kate, last time we spoke, you weren't as defensive as you are now. What's changed?
So I would say, Don, it's not that we're overly defensive. It's that, while some people have said, okay, we've created a tremendous amount of value in the market at this point, and perhaps it's now a time to step in, I think we're more in wait and see mode. We de-risked in our portfolio earlier this year. We're sitting on very high levels of cash relative to history. And as much as I want to jump in when I see some of these companies derate as much as they have, and I think we're getting closer to peak hawkishness when it comes to the Fed, I'm still remaining a little bit cautious about adding a lot of incremental risk in the near term. I'm struggling, I think, like a lot of investors, to come up with powerful catalysts aside from some technical and sort of sentiment pops to lead to a more sustained rally in the equity market.
Okay, let's talk about how to play defense then, because the defensive part of this equity market, there was a real bias there over the last few months, and then even the defensive names got caught up in some of this as well. So help us understand how best to play defense in a world that we're in at the moment.
Yeah, John, I think there's been a bit of lazy investing happening over recent months. In particular, people are looking at a defensive playbook, like perhaps to say, they want to invest in staples or utilities, as Taylor was just discussing. But those are not necessarily companies, I think, that are going to be able to meaningfully maintain their margins or even grow earnings through a slower economic growth cycle. And so we actually think defensive means looking at quality companies who have a little bit more of a kind of a Teflon earnings stream. Believe it or not, a lot of that is in technology. There's some parts of consumer where brands or services are unlikely to be you're not going to see diminished demand for them, even if economic growth slows and the Fed really manages to slow down the overall economy. So I think it's more than just looking at sectors. It's looking at companies. It's looking at business models. And it's looking about really where the future of demand is, not just what kind of the playbook we've had in the past of defensive sectors or industries.
Okay, let's talk about where that demand is, where it has been and how it's changing. As an economist, you might be looking at the rotation of consumer spending away from goods and towards services. Is that an equity story for you too?
Yeah, it is a story. I mean, I think a lot of that has started to play out already in price action, by the way. We've known that this transition from goods to services was going to happen as soon as the U.S. and global economy opened up in more meaningful size. But even within services, I mean, some of those services have meaningful pricing power. Some of them have pricing power that's enduring, as in not just a snapback to activities that people had to pull back on during the pandemic and when there were shutdowns. And so, again, this is going to be more like company by company and sometimes industry exposure, as opposed to just saying I'm rotating wholesale into services. A moment ago, you played that clip from Katie Koch at Goldman Sachs, and I think that's completely spot on. This is going to be a more challenging aggregate returns environment. And you have to be more agile, and you have to get deeper into specific stories. You're seeing this really play out as companies have reported earnings over the course of the last few weeks. It's not just good enough to have had okay results or solid results that maybe beat consensus expectations for the first quarter, but companies have to offer up guidance and give a level of assurance to investors that they have earnings power in coming quarters.
How many companies are actually able to offer guidance at the moment, Kate?
Oh gosh, yeah, that you have to catch me on that one. You're right, because fewer and fewer companies are offering up guidance than they have historically. One bit of data I was looking at earlier this morning was actually the number of companies that have reduced guidance relative to raised guidance or maintained their previous guidance. That's come down, but we're talking about a pretty small pool relative to history. Look, if you're a corporate management team, there's not a huge amount of incentive to put big, far-reaching numbers out there. The penalty for missing is pretty significant. So it's not so much just about the earnings numbers, but it's about sort of the direction of travel for their businesses that we're paying attention to.
Missing the rally on crude, there's been a big penalty for that. Energy names on the S&P up 44%. And just going through your notes, Kate, some of the calls from you and the team, this is a part of the market that you still like, the energy patch. Why is that?
Yeah, I mean, we liked energy before Russia's invasion of the Ukraine, by the way, and a lot of that had to do with a supply discipline, frankly, in the sector. And, that CapEx and supply and spending discipline we think is going to persist, even if on the margin we see a little bit more production out of other parts of the world, given the situation with Russia. That said, it's possible in some parts of the commodity complex, even though we remain really constructive, we see a slightly weaker demand environment over the course of the next few months than we saw over the past couple months. I think that will be an opportunity to add in more commodity and resource exposure for the medium term. So we're looking at any weakness, like we've seen a little bit in copper and some other base materials, as an opportunity to add for a more medium-term view.
So, Kate, am I doing that in the US or through the European names?
These are global names, right? Commodities are a global market. So some of the U.S. materials names have a little bit more sort of chemical bias to them. The global miners are listed, more often in London and in Europe than the rest of the world. And then there are really specific names, actually interesting names in parts of the emerging world, I think, that can add to your resource basket.
Are you comfortable with the beta to Chinese growth associated with some of those names?
Yeah, some of those names have had, as you point out, incredible beta to Chinese growth historically. That said, we think there's broad-based demand, both from construction and overall industrial activity, that will support, combined with relatively lower inventories than we've seen in history, and combined with not just the supply discipline we saw in the energy sector, but across a lot of the miners. So, look, it's a pretty good story. If China completely collapses, of course, we're going to see a massive sentiment hit to a lot of these names.
Yeah.
That is not our base case at this point, and certainly does not work in Xi's favor going into the fall party meetings.
Kate, I think we just had an 8-minute conversation without talking about the Fed, really, which was quite nice. Thank
It was a
you.
beautiful moment.
Wasn't
yeah,
that? That was
wasn't it?
special for you and I. You can frame that. Kate Moore of BlackRock. Kate, thank you. As always, 12 minutes into the session, equities up by almost 1/10 on the S&P, on the Nasdaq down about 1/10. Coming up, President Biden looking to insulate the U.S. economy from issues abroad.
The events of the past few years have proven beyond a doubt that America's security should never be held hostage to events overseas. Not a pandemic, not a war, not the politics of ambition or other countries.
We've joked about this all morning. The president was due to speak at 2 p.m. Eastern Time, shortly after a Federal Reserve decision. Tom Keene called it clumsy. Anne-Marie said it was curious, and the White House must have been listening because that's been moved to 11 Eastern Time. That conversation up next.
This is Bloomberg's The Open. I'm Rishka Gupta, live in the principal room. Coming up, Alan Blinder, former Fed Reserve Vice Chairman. That's at 1 p.m. Eastern, 6 p.m. London. This is Bloomberg.
We're going to ensure the semiconductors, the power of the economy, and our national security are made here in America again. And it should create and support entire families and expand U.S. manufacturing and strengthen our national security.
President Biden delivering remarks on the U.S. economy at 11 a.m. Eastern Time. The GOP's Kevin Brady criticizing the administration in a statement, writing, quote, accelerating inflation, a worker crisis, and the growing risk of a significant recession are the signature economic failures of the Biden administration and will likely get worse. AMH down in D.C. Anne-Marie, a time change from the last time we spoke 20 minutes ago. What's behind that?
Well, we don't know officially, Jonathan, but it's obviously an apparent move of what the president was up against, which was a massive decision from the Federal Reserve today. And then, of course, remarks in a news conference by his own Fed chair. Now, President Biden always wants to make sure that he stays far away from the Fed. So if this looked like there was any trace of interfering with the Federal Reserve, it does look like that is possibly why they have decided to move this speech now to 11 a.m. I called it curious before. Now it looks like it's obvious, connecting these dots, why they've decided to move up that speech.
AMH, let's talk about substance. What are you expected to hear from the president later this morning?
So he's going to talk about the deficit and how the deficit is coming down and there's less economic spending, but also from a government official, Jonathan. Take a listen to what they are saying in terms of what we can expect. The president today will speak to this important news and his commitment to reducing the deficit going forward while making critical investments to boost the capacity of our economy and lower costs for American families. Essentials like prescription drugs, health care, and utility bills. Josh Wingrove, my colleague here, White House reporter, said potentially it's an olive branch to the Joe Manchins in his party.
Do they think they can get something done with Senator Manchin still?
Potentially there could be things that can get done not as an entirety of a bill, but carve-outs of a bill. Maybe a smaller package on climate, maybe something smaller on prescription drugs, but not what we talked about 6-7 months ago with this massive bill to get really a number of agenda items that they ran on into one final piece of legislation. I mean, I don't know how many times Joe Manchin has to say it, the Senator for West Virginia, but he has said a number of times that legislation, Build Back Better, is dead.
Just quickly, there's only been one story that's dominated the news cycle in this country in the last 24 hours, and that's on abortion rights. The controversy over the substance of the leak and the leak itself. Can you walk me through how the administration has responded to this, how they are looking to respond to it in the weeks and months ahead, going into the midterms now?
So on one side, you have the Republicans really talking about the fact that this was a leak, it was egregious, and you have the Supreme Court saying they will go after the leaker. The Democrats are obviously leaning into the content of that leak. And we've heard last night from Vice President Harris, really in the most robust and impassioned speech we've heard yet from the administration, about how this is attacking self-determination of individuals. What we know this administration is going to do is going to be a huge rallying cry, Jonathan, going into the midterm elections. The president already said that himself. He said if this 1973 Roe v. Wade law is struck down, then it is up to legislators to codify this into law. That also means in November for Americans to elect individuals that are going to run on this. And Jonathan, just quickly, what we've seen in the past, like when late Justice Ruth Bader Ginsburg died, that was a huge moment for Democrats to get campaign dollars. So they are going to really push this over the next few months into November as well as into 2024.
Looking forward to see if it does indeed change the polls. AMH, thank you. The President speaking at 11 a.m. Eastern Time, as someone emailed me just moments ago. Of course, he's scheduled at 11 a.m. Eastern Time. That lines him up to be right on time at 2 p.m. Eastern. 2 p.m. Eastern, of course, is when you get a Fed rate decision. Then 2:30 Eastern, the Fed Chair, Jay Powell, in a news conference. I will not tell you who sent me that email, but joining me now is Bloomberg's Mike McKee. Mike, final word ahead of Chairman Powell a little bit later. What are you looking for?
Well, we've got some good news for the chairman and for Joe Biden. The latest PMI numbers out from S&P Global show that services PMI went up significantly to 55.6 and the composite went up to 56. We get the ISM services number at the top of the hour. Shows strength in the economy, and that would help the Fed in its efforts to raise interest rates without sending us into recession. Of course, the biggest indicator that we've had recently, the JOLTS numbers for March coming out with 11.5 million jobs open right now, the most ever. That's the white line there. The blue line is the number of people who got hired. There is a big and growing gap. So the Fed can argue we're not going to tip the economy into recession or push people out of work when there's 2 jobs available for every 1 person who is looking.
What a stat that is. That is just an incredible number. I think it's 1.94, the precise number, but whatever, close enough to 2. Mike, this is interesting going into payrolls tomorrow. The median estimate is 385. The range has been wide for the last 2 years. You know that. The high is 517, the low is 250. I keep going back to this from Citi about this shrinking pool of available workers should soon start to limit the monthly pace of job growth. They're looking for 360. Mike, are you looking at the same thing, that maybe we need to start getting used to a lower number?
Yeah, you've got to figure that that's going to start happening because so many people have come back into the labor force. You wonder how many are left outside and why they would be left outside. There was the whole argument that they got the stimulus checks and didn't have to go back to work. But now those are over, so it is time to have a paycheck. And if people are still looking, that suggests that at some point we're going to run out of people who want a job unless we pull people in who aren't looking for work. But there have been a lot of retirements, the baby boomers getting to that age. And so it's very possible that we see smaller numbers going forward.
Mike in Washington, that's good to see. Mike, are we finally doing an in-person news conference? Is that back?
That's back.
Awesome.
Haven't seen Jay Powell in person since March 2020.
Wow. Looking forward to that, Mike, and looking forward to the grilling you might be able to give him a little bit later, although, as most people realise, Mike is usually saved for the end of the news conference and then Chairman Powell runs away. I said it, Mike, you didn't. Coming up, the market-moving events you need to be watching. That'll be next in our trading diary. Looking forward to running through the week ahead and the day ahead as well, with some special live coverage coming up on that Fed decision. With the surveillance team, I'll be catching up with Tom Keene and Lisa Abramis and Michael McKee at 1 p.m. Eastern Time. Your week ahead coming right up. 25 minutes in, equities basically unchanged on the S&P. On the Nasdaq, down about 1/3%. In the bond market, yields creeping higher going into that Fed decision. A little bit later with Chairman Powell, yields up 3 basis points on a 10-year, back through 3%. On a 2-year, the highs of the year at 282.56, up 4 basis points. That's the price action. Here's the trading diary at the top of the hour. ISM services data. Then President Biden, he now delivers those remarks on the U.S. economy at 11 a.m. Eastern. We get a Fed rate decision at 2 p.m, followed by Chairman Powell news conference at 2:30. The Bank of England with their own rate decision tomorrow morning. Plus, we get another round of initial jobless claims in the U.S. And finally, rounding out the week with the U.S. payrolls report on Friday. The median estimate so far could change over the next couple of days, but at the moment at least, 385K, the previous number in the previous month. Back in March, 431. From New York, I'll catch up with you later for the Fed Show. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.